Hey guys, and welcome back to another of our courses about the complete introduction to Excel trading. So in today's course, we are gonna talk about the basics of trading, not the technical or fundamental analysis part, but really about the basics, how a transaction works, what has to be taken in consideration when we want to open up, let's say, a trade. So the first thing we are gonna talk about in this course will be the pip. So what is a pip value um, in forex trading or in general? So very simple. A pip value is simply the fourth number here. So as you can see, we have two numbers. Well, we have one euro is worth $1.08 and 25 well, less than a cent. So as you can see here, the fourth value is the value of one pip. Why we calculate everything in pips? Well, it's very simple. It's because when we open up a trade, we'll calculate our profit in pips and our loss as well in pip. Everything is calculated really in pip. Don't ask me why. It just works this way. All right. So right now you understand how it works, and well, that the pip is simply the fourth number in the trading. Well, in trading in the currency. So when you look at the currency, it's simply the fourth number. So when we calculate our commission or our spread, which will be the cost of one transaction, it's simply the difference between the buy and the sell. So let's say, for example, you are looking at the Euro USD. Your spread will be here. So how do you make this appear? Normally, you don't have it. Normally, maybe your graph looks something like this. So very simple. Your graph, this place looks something like this. So what you want to do is simply add the spread and add the high lows. All right, so the spread here, which is an exclamation mark, is simply how much will cost you a transaction in pips. So for example, if you want to open up a trade of the Euro USD, it will cost you 6 pips. All right, right now that you guys understand this, you want to put all this into, let's say, dollars. How do we put this in dollars? So very simple. What's cool about Forex is that you trade with margin. So as I explained before, when you put $1, your broker gives you access to maybe, let's say, from $10 to $500. So it all depends of the margin that you choose. In this case, well, let's say you open up a volume. You need to understand a thing that is the volume. So in this case, how you understand what's a volume, for example, for the Euro USD, you simply click, right click, and go on specifications. And on the specs, you have the contract size. So let's say you open up a volume of 1. So you decide to open a trade with a volume of 1. This means you buy one complete contract. So you open up a trade on 100,000 euros. So I'm explaining one more time. Let's say you decide to buy. So you decide to make a buy on the Euro USD. This means you speculate that the euro will go up. So the value of the euro will go up. So you buy a volume of 1. Your volume of 1 is simply the value of the contract size. So for example, if it's 1, it's simply 1 multiplied by the contract size. So it's one contract. So you will buy one contract. This means you'll buy 100,000 euros. If your volume, let's say, is 0.1, this means you buy 10,000 euros. If the value of your contract is 0.01, this means you buy 1,000 euros. Once again, that's for the volume. So the volume is simply calculated with the contract size. So a simple way to calculate it, you simply multiply your volume by your contract size to know how much money you will buy. So let's say, for example, here in our Euro CHF, which is well, two currencies. So your main currency will be the euro, and you are trading the CHF against the euro. So how you are going to trade this? It's very simple. Let's say you will take your volume and you will multiply your volume by the contract size, and this will give you how much money you will put at risk. So in this case, you will put, if you buy a contract size of 0.01, this means you will put at risk 1,000 euros. Well, this is your max risk that you will trade or you will speculate on. Once again, if you have, let's say, $1,000, and you decide to open up a contract of, let's say, 0.01, well, you have enough money. You have enough money to cover your risk. You have $1,000 for 1,000, well, and you put at risk $1,000 or 1,000 euros. In this case, you will not lose your money. But let's say, for example, you have an account of $1,000 and you decide to open up a volume of 1, which means you open up a full contract of $100,000. This will make your risk grow up, and this, and the max that you can lose will be $1,000. In this case, if, for example, the value of the currency fails by 1 cent, you will lose your $1,000 completely because everything is put in together. All right, next thing, right now that you guys understand the volume, you want to understand how you make profit or how losses happen. So let's say we take a graph. So this graph is the Euro USD graph. You can open it. And what we are going to look at is, will be, let's say we want to open up a buy. So we can open up two types of transaction in the Forex market. The first one is a buy order. So you buy the currency. In this case, you will buy the Euro. So let's say you are somewhere here and you speculate that the value of the Euro will go up. So you decide to buy the markets here. You buy your Euro there, and the value of the Euro goes up. You buy a full contract, and let's say you make a profit of 100 pips. This means, well, how much money you've made. So if your profit per pip is $10 because you opened up a volume of 1 and you opened up a contract of 100,000, this means if you make the calculation, your profit or loss per pip will be around $10. If you made 100 pips of profit, this means you made $1,000 of profit. How I calculate this fast? It's very simple. You take your lot size, which is, for example, in this case, we'll say 0.01, and you want to calculate how much how much this will cost you. So you simply take the last decimal. In this case, it's 0.01, so it's gonna cost you 1 cent per pip. 10 cents per pip, because you will multiply it by 10. So if I open up a contract of 1, it's gonna cost you $10 per pip. It's as simple as this. And once again, it's just an approximation, because depending on the currency, it will depend a little bit, but it's gonna be around $10 per pip. Once again, as I said, it's an estimation. The calculation is a bit more complicated, and normally it's a bit more or a bit less, but it's around, let's say, $10 per pip when your volume is around 1. So when it's 1, it's something around $10 per pip. So very simple. If you want to calculate how much money you will make per pip or lose per pip, as I explained, you can calculate it this way. So if it's a volume of 1, it's going to be around $10. If it's a volume of 0.1, well, 0.01, it's going to be around, let's say, $1 per pip. So if you open up your trade here, let's say it's at 1.08, and you close your trade at 1.09, you just made 100 pips, which is 1 cent. And this 1 cent will give you $100 if you opened it up at a volume of 0.1. If you opened up this trade at a volume of 1, you would have made $1,000. Next thing, how can you lose money? Well, it's very simple. Let's say you're here at something around $1.09 per euro, and let's say you decide to open up a buy order here, and the value of the dollar fell. So if here, let's say you close your trade there, so it fell by 75 pips. So what just happened? You just lost 75 pips. This means if you opened up your trade at 0.1 of volume, you lost $75. How I calculate this? Well, I lost 75 pips. I multiply my 75 pips by, 75 pips. I multiply it by $1 per pip. This means I lost something around 75 pips. But don't worry about the calculations of all this. When you open up a trade on, let's say here on MetaTrader, it will automatically say you how much money is at risk and how much money you can possibly win or lose, depending on when you put, where you put exactly your stop loss or your take profit. All right. So right now you understand that you can do the first thing, which is a buy order. The next thing you can do, you can open up a sell order. In this case, let's say you are somewhere here. and you decide to, and you want to make money because you think that the markets will fall down. So what you will do, you will open up a sell order. In this case, it's just there. Let's say I decide to open up a sell order. It's very simple. As you can see, the order has been opened. So what it means? It means for every pip that will, for every time that the market goes down, if the market keeps going down, I will make my profit. So in this case, for example, if I open up my trade here, every time that the market falls by 1 pip, I will make $1 because the volume is 0.1. So if I'm somewhere at 1.11 and the market fails at 1.10, this means I lost 100 pips. This means I lost something around $100. Once again, as I said, it all depends of the currencies. It all depends of what currencies you will trade and what currencies are involved. But usually when your main account is in USD dollars, it's going to be something around, for a volume of 0.1, it's going to be around $1 per pip. But once again, it all depends of currencies. It can be sometimes a bit more, it can be sometimes a bit less. It's after that, you have to make the calculations. So, but theoretically, if it failed by, let's say, as I said, 100 pips, I just lost $100. I just won $100. And in the other case, if, for example, I open up a sell order here, and the markets go up, I will lose money. So why? Because I opened up a sell order, which is only profitable when the markets are going down. I'm not gonna explain how works a sell order and what is because it's a bit more complicated. But just for you to understand, if the markets go up, you open up a buy order, you buy the market, so you buy the currency. And if the markets go down, you simply sell the currency to buy it a bit later. That's the goal. So let me explain it. Let me try to explain it. How works the buy and the sell. So when you buy the currency, the first thing, let's say you want to buy the currency. When you click on the buy button, the currency goes up. But to close your transaction, you will sell your currency. Once again, it looks a bit complicated, but everything. The only thing that you have to understand is if the market goes up, simply click on buy. If you think that the markets go down, simply click on sell. That's it. So that's for the two types of orders that you can pass when you trade the Forex market. All right, so right now you understand how all this works. Next thing is the commission. How you calculate how much commission you will pay. So as I said, your commission is here in pip value. How you will calculate the cost of your trade. So when you open up your sell order here, the cost of your trade will simply be, let's say in this case, I will win $1 per pip. So if I open up my trade, it's gonna cost me, well, in this case, it's 0.6 pip. So it's gonna cost me 60 cents. Why? Because once again, here, the value is in pipettes. So in this case, it's written 6, but it's not 6 pip. It's 0.6 pip. Why? Because here, what they write is simply the value, the difference between this value and this value. And the difference between those two values is 0.6 pip. So it's very simple. As I said, how much my trade will cost me. In this case, it will simply be 0.6 multiplied by how much I win or lose by pip. So for example, if I make $1 per pip, well, in this case, my commission will be 60 cents. In this case, my commission will be $1. Here too is going to be $1. Here is going to be $1.50 with a volume of 0.1. If, for example, I trade a volume of 1, this means that my trade will give me, or I will lose $10 per pip, or something around $10 per pip. So here, my trade will cost me $10. Here, my trade will cost me $7. Here, it's gonna cost me $44. So I hope you get the point. All right, next thing that we are gonna talk about, once again, we saw our contract size. Next thing that we will talk about, as I said, will be the swap. So another very important thing for you guys to take in consideration is the swap that you can trade. That you will have to pay in case that you decide to invest in a certain currency. So let's say, for example, I decide to open up a trade, I don't know, here, and I decide to keep the trade for, let's say, 1 week. And I opened up a trade at a volume of 1. This means I got access to 100,000 euros. But when you, let's say, go to the bank and decide to loan money, so you go to the bank, you take money, you need to pay interest on this money. So it's the exact same thing on the Forex market. Let's say you open up a trade with a volume of 1. This means you got access to $100,000. And the cost of this money, of this $100,000, will be, if you decide to buy the 100,000 euros, it's gonna cost you 4.26% yearly. So you will pay 4.26% on your contract yearly, but on a daily basis. So it's gonna cost you something around $4,260, but you will pay for this amount daily. So every day you will pay let's say a small percentage of all this. This is for the swap. You have the swap long, so this means when you buy, long it's buy. So when you buy the markets, that's your swap. So this is how much it will cost you to hold a buy position or a long position. And this is the swap that it will cost you, the interest that this will cost you to hold a short position or a sell position. So in the first case, in the Euro USD with AvaTrade, your swap cost, so for example, you opened up a transaction here, a buy transaction, and you kept it for, let's say, 2 or 3 days, it will cost you 4.26% to hold it yearly, but you will pay this on a daily basis. So you will pay a small amount on a daily basis. Normally, the swap can be positive or negative. In this case, it's negative, but you have some currencies that they have that have positive swaps. So let's say, for example, you open up a trade and you will receive money on a daily basis because you hold the position. But once again, it's not all currencies, and usually the currencies that have positive swaps are more risky. But once again, it depends. With AvaTrade, usually it's this, and you can see this as dividend payments or as interest. It's because it works a bit the same way. It's not a dividend payment at all. It's really positive interest that you can receive. For example, if you open up a transaction on a currency that have a positive swap, it's simply an interest rate that you guys will receive just for holding the trade. But once again, and it's paid daily. But once again, it's not a dividend. It's just an interest rate. The same thing if you open up, let's say, a trade with a negative swap. That's what's gonna happen. You will simply pay an interest rate because the swap on the currencies is negative. So this is how works the forex trading. So let me just summarize everything that we just saw. You can do 2 things in trading in general. You can buy the markets or sell the markets. When you expect the markets to go up, you buy the markets. When you expect the markets to go down, you sell the markets. After that, if you want to understand how much your volume is gonna worth, you simply look on contract size. So in this case, for example, your contract size is 100,000. So this means if you open up a volume of 1, you will open up a contract. You will take $100,000 euros here. So it's your margin currency. You will take 100,000 euros. This means you just bought this amount of euros. For the rest, how you calculate, well, how you see how much the transaction will cost you, it's gonna be here. So this is the value in pipet, which is the last digit here. And you simply, well, it's 0.6 pip, 1 pip, 1 pip, 0.7 pip. So it's gonna simply cost you your volume multiplied by, well, it's gonna cost you around, so here it's gonna cost you 60 cents, it's gonna cost you $1 if you open up a volume of 0.1 once again. So very, very simple to understand. Once again, it's all a question of practice. The more you practice it, the more you'll see it's gonna be easy. A last thing that we didn't saw yet, and that is very important to understand, is the margin, since you always have to leave a certain margin when you trade. So let's say, for example, you have an account of $100,000. Well, I'm sorry, $1,000, and you decide to open up a trade of $100,000. First of all, your broker need to give you access to this $100,000. And in some cases, with only $1,000, the broker won't give you access to this amount of money. Why? Because it's very simple. When you open up your account with your broker, let's say, give you access for $1 that you put in your account will give you access to $20. In this case, if you have a $1,000 account, the max amount that you can trade will be 20 multiplied by how much you have in your account. So it will be $20,000. This means the max volume that you will be able to trade will be 0.2. Why? Because the broker give you access only to $20 for each dollar that you put in your account. In let's say another case, the broker gives you access to $500 per dollar that you put in your account. So it's gonna be one for 500,000 of one for $500, your margin. So this means if you put on your account $1,000, the broker will give you access to $500,000, and you will not have to put a huge margin on each of your trades. So the more the broker gives you access, the more money the broker gives you access to, the less margin you will have to leave, for example, to trade. But the less the broker gives you access to money, the more margin you will have to leave to trade. So once again, you'll see this when you put your first trade. You will have to leave a certain margin. For example, let's say in the case that you have access to $20,000 with $1,000, this means that you will have to leave as margin $1,000 each time that you open up a 0.2 trade. So each time that you get access to $20,000. So let me just explain once again. Let's say you decide you have $1,000 and you decide to open up a trade of $10,000, and your broker gives you access for each dollar that you put on your account to $20. This means that if you open up a trade of $10,000, which is a volume of 0.1, you will have to put a margin of $500,000, because with you will have to put a margin of $500, because with $500 you will have access to $10,000. This is simply the calculation that you do. So as you can see, those are the things that we saw today about the Forex. So right now you understand what is the commission that you will pay, that you can do two types of transactions. You can buy or you can sell. That you need to take in consideration the swap, and you need to take in consideration the margin when you make your Forex trades. So that's it for this course, guys. Right now, that's the only basic that you need to know. The next thing that we are gonna talk about will be fundamental analysis, and we will see this in our next class.